Welcome to Peachtree Point of View with Greg Friedman, the podcast that shares insights and strategies to navigate dislocated markets and capitalize on mispriced risk.
Hi, I'm Greg Friedman, CEO of Peachtree Group, and this is another episode of Peachtree Point of View. We're very fortunate today because we're here with Aaron Jodka. Aaron's he's been part of our podcast in the past. He's with Colliers, and he tracks a lot of the economic data, as well as he's tracking the commercial real estate market. So he has a very interesting view of just what's happening across commercial real estate, private credit. And Aaron, thank you for being on this podcast today with us.
Oh, my pleasure. I appreciate the invite.
And just to sort of jump right into it, because there's so much happening in today's environment, we're obviously dealing with a higher for longer, long-term interest rate environment. Even short-term rates are higher, but the Fed's starting to reduce rates and they're showing some signs of easing, which is music to the ears of most owners of commercial real estate assets. But maybe just sort of level set the discussion right now. What's your view of the state of the market? How do you see commercial real estate today?
Yeah, there's plenty going on to keep everyone on their toes. But I feel that the state of the commercial real estate markets are in a state of rebalancing, where we're seeing improving signs of fundamentals across most asset classes. So you're seeing a return to office, better absorption trends on office nationally in a number of local markets. You're seeing a slowdown in multifamily construction, very limited development on the retail side, industrial rebalancing as well. That supply pipeline has really dropped off. And in hospitality, again, very little supply side pressure. So you have a really good storyline where continued economic growth will lead to additional demand, which will in turn improve occupancies and spur some rent growth. So we think that we're at the start of the new cycle. Pricing is improving. We're starting to see that improvement from a capital flow standpoint. Debt is readily available, and investors are starting to become more active.
So I hear a lot of different views, especially over the last couple of months. This year has been very chaotic with the new administration. There was a lot of optimism that commercial real estate had bottomed at the end of last year, beginning of this year. And a lot of people thought values were going to quickly accelerate up, just given the new administration having such a pro-business, pro-tax viewpoint, as well as they were going to inject the new initiatives. Then we get the tax bill that the new administration was pushing, that was approved, which technically was a catalyst. But then we've had tariffs discussions and we've had inflation showing some signs of being some level of stickiness. Do you think, just as you look across the US, there's been still a lot of discussions about softening of demand as it relates to hotels, even multifamily housing? And candidly, it's a little bit as concerning as it can be at times with hotels. I feel like it's more concerning even on the multifamily side because they trade at such risk premium spreads are so thin on some of those trades on the multi side. From your standpoint, do you think this bottoming and this recovery, I guess when I say bottoming, really the recovery in values, do you think it's sustainable or could it revert from your perspective?
I do think it is sustainable. Of course, some economic shock comes in and we see a recession. We see war. We see some type of black swan type of event that, of course, that will rock the trajectory here. But I do think it's sustainable. It shouldn't be a V shape. I wouldn't expect that all of a sudden, we'll have 10%, 15% rent growth or value growth in a short period of time. It's going to be a slow and steady climb because the environment and backdrop is different today than it was coming out of the global financial crisis. Coming out of the GFC, we had an alphabet soup of programs in order to support CMBS, to support valuations, to help kick the can and sort of work our way through this and lowered interest rates. Because of inflation, because of a higher for longer interest rate environment, we don't have that same backstop. The Fed is easing its quantitative tightening, but they're not going into quantitative easing either. So we can't look to the federal government and the Fed to just buy everything and keep that liquidity. We have a different underlying price structure from a cost of capital, a debt standpoint. With that will make, in my opinion, the value growth a little more measured than we may have seen in past cycles and rebound.
Just looking at in investors investing in commercial real estate, because I know y'all track a lot of this data as well. The transaction environment has obviously been down over the last couple of years compared to where it's at pre-2022. And so investors have been somewhat weary, or at least the transaction market's been weary just because people aren't able to buy at levels that make sense and sellers are not willing to sell in the current environment. Are you seeing from a standpoint of just being able to fundraise, which is I would argue somewhat reflective to the transaction market because there's just not been a lot, at least the transaction market's been relatively muted. But are you seeing signs of a lot of momentum on the fundraising side for fund managers and so forth?
It's starting to get better. I'm not saying it's easy. I've got a slide that says that fundraising is still tough sledding, and that is the case. But we're off the bottom. Last year seems to be the low point of fundraising, and we're starting to see that momentum improve. Through the third quarter, we already have more fundraising year to date than we had in all of last year. Again, coming off of a low, but at the trajectory that we're looking at, we should be at a decent level of activity. And then also sort of the framing of where volume is. I think we're still stuck on 2021 and early 2022 are normal, and they're not. Those were amazing times to live through and experience, but that was not a normal investment sales environment. So if you were to sort of back that time period out and look at a pre-COVID level, 2016 to 2019, and I told you that the market's 10% below that, you'd feel pretty good. And depending on the asset class, there's some variation, of course, but multifamily is about 10% below that pre-pandemic average. Industrial's 25% above that average. So there's some real differentiation across markets. In the office market, far lower than that boom period. But I think that context of where we are versus what a more normalized market is can also help make you feel a little bit better about today's environment. In aggregate, the billions of dollars that are transacting on a daily basis are pretty healthy. This is nothing like coming out of the global financial crisis where the market completely stopped and we were concerned about the health and potential viability of our financial markets. We don't have anything like that. It's just not free money and low cap rates for everyone.
Right. I mean, it's just interesting because as you mentioned, coming out of the GFC, we went from this interest rate environment very similar to what we're experiencing right now to having those 0%, or really effectively a 0% interest rate environment. And that's really what caused cap rates and values to eventually really accelerate upwards. And it feels like we don't have that, catalyst right now to help drive values as quickly as we saw, at least as coming out of the GFC, as we started to have some signs of positive recovery. It felt like the recovery happened a lot quicker than most people expected, given how fast we had fallen. So are you pretty optimistic that 2026 will be a much better year than 2025 when you look at just as it relates to capital raising and transactions and commercial real estate, people actually being able to buy and sell? What do you see happening at that level? And then just even at the asset level from a performance perspective, what do you see happening with the economy?
I do. I think the backdrop, again, going back to that fundamental story, will be stronger in 26 than it is in 25. And you can start to look ahead and with more confidence underwrite rent growth, underwrite room rate growth, et cetera, depending on your asset class. And that's going to help grease the skids, so to speak, on some of these transactions that are stalled in some cases. Fundraising is improving. That is a good backstop. There's still tens of billions, hundreds of billions of dollars sitting on the sidelines that have been sort of trapped. It hasn't recycled that same level of capital, and that money needs to be deployed. And at some point, that pressure is going to build. That money is going to start going. So I'm optimistic there. You still have plenty of refinancing opportunities and debt maturities that need to be restructured one way or the other, and there'll be several $1 billion of those people. We'll push that out to 27. We'll figure it out next year. There's that kick the can mindset, but that's going to create some opportunities. We're seeing special servicers becoming more active. We're starting to see banks take some buildings back. So some of the distress that's been hanging around for a little while will start to clear, and that will also open up the markets to some extent. And again, that broad debt market is really moving. CMBS is on a record-setting pace outside of the pre-global financial crisis, and we probably don't get back to that level anytime soon because it was a very different underwriting environment then than where we are today. But that pace is on a record-setting pace. Private capital is readily available. Banks are active. Insurance companies are active. Agencies. So there's plenty of debt. The question comes down to how much equity is there and how does that balance of risk reward on your equity versus your debt plays. So we've had a lot of debt focused on everything. Well, now we're starting to see a bit more of that equity come to play. And I believe that reset basis is also a key sort of storyline for 26. If you assume a more gradual recovery, well, all this money that I've raised or the money I'm raising, the strategy I'm putting together, I can still deploy that in the next 6 to 12 months, 24 months. There isn't that risk of, I missed the first quarter of 2026. What am I going to do? All the returns are gone. I don't anticipate something along those lines, but if you do start to see more momentum, well, that sometimes begets more momentum. And if you see some of these major institutional players coming back in or cross-border capital buying portfolios and you start to see these billion-dollar deals again, well, now you start to get that fear of missing out, and I think the market can really pick back up. I don't expect a 50% increase in volume or anything along those lines, but we're up about 15% through the third quarter, year to date and year over year. So I think something like that type of trajectory is reasonable and something to expect in the year ahead.
Got it. And let's talk private credit for a second, because the investing in commercial real estate investing on the equity side has been super challenging, because we've talked a lot about the transaction market, being down compared to what we saw 2021, 2022, the latter half of 2022 and 2023 and 2024. Transactions were muted. Things started picking up this year, technically, but it's still down compared to 2021. But as we look at the market, obviously from my perspective, investing in private credit has become mainstream, and the media has really glamorized the terminology private credit, going back to 2023. I feel like it's one of these things that people didn't realize private credit existed until probably 2020, towards the end of 2022, first part of 2023, when the media started picking up on it. But it's something we've been doing as a firm since 2010.
Right.
It's been around since the beginning of time. Just anyone that's ever, gotten a loan from a private party is effectively private credit, or from, some non-bank financial institutions. In a lot of cases, it's just private credit, the way these things are being structured. Even great financial crisis, it was out there at some level. And then there's different forms of private credit as well, because you have private credit investing on the corporate level, or making loans at the corporate level, or making M&A loans. You have private credit like that we're really referencing as it relates to commercial real estate, funding the acquisition of properties, providing construction loans to build new commercial real estate projects, if it's hotels or multifamily, industrial, retail. That's what we do on the private credit side, as well as we buy loans from banks with the idea of restructuring them back into performing loans.
Mm-hmm.
What's your take? Just because private credit, as I talk about it being glamorized a couple of years ago, and really up until the last couple of months, it's been glamorized by the media. It's now is really being villainized because there's been some cases of fraud and things like that. How do you view private credit in commercial real estate? Is that an investment strategy that you agree with? Is it something that you think is sustainable, or what's your thoughts around it?
It's very sustainable. It's been one of the driving forces in commercial real estate for the last 15 years, if not longer. To your point, coming out of the global financial crisis, the market changed and it grew and it expanded, and private credit became a far bigger piece of the pie as these banks were trying to figure out, can we survive? What do we have on these books? We've just merged with these other banks, or we've been put together in whatever marriages they were. Like, what do we have? They didn't even know what was on their balance sheet. And that created a void. And if you follow along with the investment sales activity, it plummeted in 2009 and was really tepid in 2010. And private credit was, we can fill a void, right? We can customize these different loan terms. And of course, there's risk reward involved there. And it was a tremendous opportunity to backfill a more highly regulated banking industry, a banking industry that was pulling back on some of the real estate investing that it did. And we kind of saw a little bit of a pivot as well, where the community banks became a bigger player in some aspects, while the larger banks were pulling back on some of their lending. Of course, they're still huge players in the market. It's not like they went away. But private credit has been tremendous. And it's something that's been in commercial real estate, as you said, it's the dawn of time, really. Real asset investing versus corporate investing are different, and those structures can vary. Sort of more stability within a real estate portfolio. Yes, values will change and things can change in a hurry, but the values don't necessarily adjust overnight. And there's noise and there's headlines. And of course, if you watch REIT stocks, they'll go up and down. But private real estate helps smooth out some of that noise. They generally don't run all the way to the peak, and they don't come all the way to the bottom. So you kind of lop those ends of tails of a distribution off in a lot of ways. And that's been very attractive to a number of groups. Insurance companies, for example, they have a much higher share of their assets invested in private credit today than they did a decade ago. And part of that, it lines up well with their longer term liabilities. They can hold on to less liquid assets because, I don't need them. I'm a life insurance company. We will have liabilities over time, but I need income or annuities, et cetera, et cetera. So they don't need that. Well, I got to sell it tomorrow. Like, Greg, let's sell that building. We got to go tomorrow. They don't need that type of liquidity. And I think that bespoke nature of private credit is It's very important. Now, are there folks that are less diligent on their portfolios and on their underwriting? Certainly, there's going to be some fallout there. I mean, Jamie Dimon made that comment about you see one cockroach, there's usually more. So there's probably going to be some fallout. There always is. Any cycle. But a couple of the companies that went out, it's subprime auto lending, which if you look at the delinquency rate on subprime auto lending, it's up. Cars are expensive, loans are high, and people can't afford them. And when you have an interest rate that's in the double digits and something goes wrong, your car doesn't pay off. You have those challenges. So yes, there's been some headlines, but it really hasn't been related to real estate. It's not real estate's fault this time.
So as you look at investing, so for 2026, and as you look over the next couple of years, do you think you ultimately get better returns as an investor investing in private credit or investing in true equity positions across commercial real estate where you're taking the last dollar equity risk? What do you think will produce better returns?
So I think we're still in a period where private credit is still on a risk reward benefit outweighing equity. But I think that pendulum is starting to swing where that equity investment is starting to look really attractive, particularly in some of these deals where there isn't a lot of equity. You kind of have a little more control and you can start to, expect some decent pops, and spreads are down. So the numbers are starting to work a lot better than they did 18 months ago, 24 months ago, as the Fed was raising rates and we didn't know where they were going to stop and we didn't know when it was going to stop. So I think that medium point is starting to come together.
I totally agree with you there, because I feel like the Fed, as they become more predictable, I think private credit will continue to be a viable asset class to invest into, but I think equity is going to become a little bit more compelling. But I would say investing it through special situations, like if it's providing like more pref equity, rescue capital, or more of a structured purchase, I think there's going to be some interesting opportunities where you can buy assets at the debt balance. Maybe in some cases they're short sales, and get, and enter at a very compelling entry point into some of these commercial real estate assets. Now, the other question I would ask is, so if you're investor looking at commercial real estate, what asset class would you look to allocate to when you're looking at hospitality, multifamily, industrial, office, or even the other asset classes? Which ones do you think are the most compelling as you look at 2026, 2027, based on what's happening right now?
I think there's a case to be made for interesting strategies across those asset classes. I really like retail at the moment. We're not building very much across this country. I will make the argument that retailers are more nimble and better acclimated to the omni-channel environment where you're buying in store, shopping online, picking up in store, whatever it might be. Try to understand that experience, because at the end of the day, e-commerce is growing as a share of business. The vast majority of purchases are still in brick and mortar. And that spread between a shopping center and a distribution center is still pretty wide. So they're both sort of means of getting goods to a consumer. One just comes to your door, one you got to go pick up yourself. But that spread seems pretty wide. I think the generational opportunity for office is really intriguing. Now, not every single office building, and I don't want B buildings that were high vacancy before the last cycle, but true main locations, trophy assets are doing very, very well. Whether you plan to convert or keep as office, there's some really intriguing plays there. Now, the basis makes a difference, and in some markets, the cost to re-tenant that space and ultimately get it fully occupied may not be justified, but in a lot of markets it is. And that's a really interesting one. And I think from a core perspective, the long-term trajectory behind industrial and behind multifamily are sound and has not changed. Yes, they've had some supply. That is becoming less of a concern. And once that demand story returns, I think both those asset classes could really do well. And then on the hospitality side, I mentioned the lack of construction, which is really good. And I think you got to pick your spots and understand who you're catering to. And if you look at where demand is coming from in this economy from a spending standpoint, it's a smaller subset of Americans that are driving it. And can you cater to that marketplace that has the disposable income and can easily travel and spend.
So as we close this out, because this is really great information for everyone listening, but as we close it out, what are you most optimistic as we head into 2026? And what are you concerned about? I know there's probably different data points you're paying attention to, if it's like the movement of the 10-year treasury rate, or employment data, or whatever the case is. What is probably the most critical data point that you're following as well?
Interesting. So I'll lead with optimism on next year. I still think that the data center play is early. We're in the early innings there. Now it's an expensive and takes some expertise here. You can't just say, oh, I'm a data center expert now. That's not how that world works. But the potential of AI is transformational. And I think there's some real opportunity there. From a concern standpoint, I'm watching inflation. I think there's opportunity for that to come back in as home price appreciation has really cooled. We're seeing a slowdown in rent growth on the multifamily side, and a big chunk of CPI is housing related costs. So that should start to weigh. But if inflation continues to tick up, sticks around 3%, the risk is that the Fed stops cutting. Maybe they need to increase rates and what that would potentially do to the market. So that's probably my biggest concern is watching inflation. And then from a data standpoint, I pay a lot of attention to the 10-year treasury. It was nice seeing it down with a 3 in front of it a week or so ago, but now we're a little bit higher at the time of this conversation. But I'm closely watching the performance of the 10-year, as so much commercial real estate is based on 10-year treasury as opposed to SOFR. Some of the floating rate debt is very much SOFR, and what the Fed is doing is lowering those costs. But at the end of the day, so much of this permanent debt is tied to the 10-year.
Yeah, I am very focused on the 10-year, and I'm a big believer. The 10-year really represents the risk-free rate, and it's something that when you have a good understanding of it, you can have a better understanding of true intrinsic values of these assets you're investing into, and you can make a better decision if you're buying. Because when you're investing, you want to buy things at a discount to the true intrinsic value as you look over your hold period. You want to be at a discount so you can hopefully sell, back at the, valuation or at some premium to what you paid for. And if you're that's the quickest way to lose money in any investment, including commercial real estate. So it's so critical to understand the intrinsic values and what's really happening. With that said, I know we're running out of time. Aaron, I want to say thank you for joining us today. There's no question that, is a little bit different than what we experienced over the last couple of cycles where we have higher rates. Typically, when you're going through this type of dislocation, usually you've seen the Fed just drop. They'll drop rates back to zero. That's not what's happened this cycle. Actually, we have higher rates, especially long-term rates remain stickier for longer. And it's all about really a rediscovery of the fundamentals if you're investing in commercial real estate and making sure that you're being very thoughtful about how you buy assets, because you make your money in real estate on the buy side usually. So you got to buy right, and then you got to have the right set up on the asset management side and the operating side to make sure you're optimizing and driving, the performance. There's no question capital is shifting and risk is being repriced across the board, but there's a lot of opportunity that's forming all over real estate, both on the equity side and the private credit side, as we've talked about. Again, I just want to say thank you. Everyone that's listening today, please, tune in for the next episode of Peachtree Point of View. If you do have any questions, feel free to, I know Aaron would be happy to answer any questions you have as it relates to commercial real estate and the fundamentals and the data that he's seeing, with him being the director of research for the U.S. capital markets at Colliers. But feel free to reach out to him directly, or you can always reach out to myself, Greg Friedman, again, CEO of Peachtree, and thank you.
Thanks, Greg.
Yeah, thank you, Aaron.
That's it for this episode of Peachtree Point of View. If you found value in the conversation, hit subscribe and share it with your network. For more insights, visit us at peachtreegroup.com. And until next time, keep crushing it.